Many people believe that investing is only for the rich. They imagine that you need tens of thousands of dollars before you can even think about entering the stock market. Because of this belief, millions of people delay investing for years, sometimes decades, waiting for the right moment or a larger amount of money. The truth is very different. You don't need $10,000 or $50,000 to start investing. In fact, you can begin building wealth with as little as $1,000. What really matters is not how much you start with, but how early you begin and how consistently you continue investing over time. Starting with $1,000 may not make you rich overnight, but it can be the first step toward building long-term wealth. When you invest wisely and give your money time to grow, even small amounts can turn into something much bigger. However, before investing that money, there is something extremely important you need to understand. Not all investors are the same. Every person has a different tolerance for risk, a different time horizon, and different financial goals. Because of this, financial experts usually divide investors into three main profiles: conservative, moderate, and aggressive. Understanding which type of investor you are is one of the most important steps before putting your money into any investment. Let's break down each profile and see how someone with $1,000 could start investing based on their risk level. First, let's talk about the conservative investor. A conservative investor is someone who prioritizes safety above everything else. This type of person prefers protecting their money rather than taking risks to grow it quickly. Conservative investors usually feel uncomfortable with large fluctuations in the value of their investments. If they see their investment drop significantly, even temporarily, it may cause stress or anxiety. Because of this, they prefer stable investments that grow slowly but steadily. If you are a conservative investor and you have $1,000 to invest, your main goal should be stability and long-term security. One common option for conservative investors is broad market index funds. These funds track the performance of an entire market or a large group of companies. Instead of trying to pick individual stocks, you are investing in hundreds or even thousands of companies at once. This diversification helps reduce risk because the performance of one single company will not have a huge impact on your overall investment. Index funds have become extremely popular because they are simple, relatively low risk, and historically have provided solid long-term returns. Another option for conservative investors could be bonds or bond funds. Bonds are essentially loans you give to governments or companies in exchange for regular interest payments. They typically offer lower returns than stocks, but they also tend to be more stable. A conservative investor with $1,000 might choose to divide their money between an index fund and a bond fund. This creates a balanced portfolio that focuses on preserving capital while still allowing some growth. Now let's move to the second type of investor, the moderate investor. A moderate investor is someone who wants growth but is also aware of risk. They are willing to accept some volatility in the market if it means potentially higher returns over time. Moderate investors understand that markets go up and down, and they are comfortable holding their investments during those fluctuations. If you fall into this category, your strategy might include a mix of different assets. For example, someone with $1,000 might invest a portion in index funds, another portion in dividend-paying stocks, and possibly keep a small portion in safer assets. Dividend stocks are shares of companies that regularly distribute part of their profits to shareholders. When you own these stocks, you may receive periodic payments known as dividends. This can create a form of passive income while your investment continues to grow. Many investors like dividend stocks because they provide both income and potential long-term appreciation. A moderate investor could choose a simple strategy such as allocating 60% of their money into an index fund, 30% into dividend stocks, and keeping 10% in cash or safer assets. This type of portfolio still aims for growth but includes some stability. Finally, we have the aggressive investor. An aggressive investor is someone who is comfortable with higher risk in exchange for the possibility of higher returns. These investors understand that their portfolio may experience significant ups and downs, especially in the short term. Aggressive investors are often focused on long-term growth and are willing to tolerate volatility along the way. If you have $1,000 and consider yourself an aggressive investor, you might choose to allocate more money into individual stocks or higher growth investments. Growth stocks are companies that are expanding quickly and reinvesting their profits to grow even faster. These companies may not pay dividends because they prefer to reinvest earnings into the business. The potential upside can be significant, but the risk is also higher compared to diversified index funds. Some aggressive investors also allocate a small portion of their portfolio to newer or more speculative investments. However, it is important to remember that higher potential returns always come with higher risk. That's why even aggressive investors often keep some diversification in their portfolio. A possible aggressive allocation for $1,000 might include 70% in growth stocks and 30% in a broad market index fund. This approach allows for higher growth potential while still maintaining some diversification. Now that we have covered the three investor profiles, there are a few important principles every beginner should follow when starting to invest. The first principle is diversification. Diversification means spreading your money across different investments. Instead of putting everything into a single asset, this reduces risk because if one investment performs poorly, others may perform better and balance the portfolio. The second principle is consistency. Investing is not about putting money in the market once and hoping for the best. The real power comes from consistently adding money over time. If you start with $1,000 and then invest even small amounts regularly, your portfolio can grow significantly over the years. The third principle is patience. Many beginners expect quick results from investing, but the real power of investing comes from long-term compounding. Compounding occurs when your investment gains begin generating their own gains over time. This creates a snowball effect where your money grows faster as the years pass. For example, if you invest $1,000 and continue adding $100 per month, the long-term growth can be much larger than most people expect. Over time, Consistent investing combined with compounding can transform small contributions into substantial wealth. Another important rule for beginners is avoiding emotional decisions. Markets naturally go through cycles of growth and decline. During downturns, many inexperienced investors panic and sell their investments at a loss. Successful investors understand that market volatility is normal. Instead of reacting emotionally, they stay focused on their long-term strategy. Finally, it's important to remember that investing is not only about money, it's also about knowledge. Learning about markets, understanding different asset classes, and developing financial discipline are all part of the investing journey. The earlier you begin learning and investing, the more time you give yourself to benefit from compound growth. Starting with $1,000 may seem small today, but it represents something much more important, the beginning of your investing journey. The difference between people who build wealth and those who don't is often very simple. One group starts investing early and stays consistent. The other group waits. If you have $1,000 saved, you already have something powerful, the opportunity to begin. The most important step is not finding the perfect investment. The most important step is simply getting started.